This is Mastering Your Wealth with David Gagnon, the podcast.
Trump and his team continues to use the threat of tariffs on certain goods coming into the U.S. We know that's been a big conversation over the past few weeks here. So the big question everyone wants to know is, what could we expect if and when the dust settles? Here's NBC News reporter Christine Romans.
You'll feel it in a new car, anywhere from $3,000 to up to $12,000 extra for the price of a new car. But maybe first you're going to feel it in the grocery store. Think of all of those things that are imported from Mexico and China. Mexico in particular, all of that fresh produce, all these perishable items. From Canada, we get gasoline. From China, we get electronics and toys. Mark Zandi over at Moody's Analytics says you should expect another $1,200 to $1,300 a year for the typical household just for the higher prices for all of these things.
All right, so I think we've all kind of been hearing this, about the cars and, of course, certain goods that you're going to find at the grocery store and stuff like that. So, add this already to the creeping inflation and volatility of the stock market. It is, of course, stressing a lot of folks out here, David. So is this just us, having more worry, and are we staying the course enough? I mean, basically, how can you take a little bit of this anxiety away and make sure we're on course?
Well, with the tariffs, obviously, companies that are going to be hit with these tariffs that are importing to our country are going to have to pass on the cost to the consumer, right? But prior to 1913, this country operated on tariff structures, right? We didn't have any income tax, and then the income tax was supposed to be temporary in 1913 at a 7% rate, but then they got caught on the tax. When the government started collecting these taxes, it was like they were on a drug, right? They couldn't let it go anymore. And so we just have, ever since then, have had the tax code. But with the tariffs kicking in now, I think what the Trump administration is trying to do is provide incentives for many of the companies that went offshore to create these goods that are shipping back to the U.S. to come back to the U.S. And in the short term, it might take a while, but I think cost of a lot of goods and services are going to go up that are coming into this country from other areas. But I think when we start seeing a transition of companies coming back onshore and producing these goods and tapping into our vast resources for energy, and when we start doing that, I think a lot of the cost will start coming down. And, I think it's just going to take time. And I think people are going to have to find ways in their finances to adapt to this and make sure they do good planning to make sure that they can stress test it for the potential increase on areas of cost that they can't control. I mean, there's some things that you can delay in buying, right? If you're going to buy a new car, but you don't really need one, maybe you wait a while and let the dust settle to see where the cost of cars go. But it's going to take some time. I mean, people have to reestablish their companies back here. And if there's some good tax incentives and some good breaks for these companies to come back on shore, then the more goods and services we produce in the U.S., I think in time, we can control and have better access to goods that are affordable at a lower price.
Yeah, I mean, I think really that's kind of what everyone's hoping and thinking. But the bottom line is we don't have a crystal ball, folks. So we don't know when or how or if all these, chips are going to lay. So the bottom line is you have to have a plan in place, right? When you agree, David, to protect and grow your assets, no matter what's going on. If it's the tariffs, if it's inflation, if it's market volatility, because of the tariffs that we're seeing. I mean, it's kind of a snowball effect here with this administration. I literally feel like every day I turn on the news, there's something new that's impacting some other, financial or economic state of our country here. So I know a lot of other people feel the same way. How can we best protect ourselves and our money with this really being unknown territory? And quite frankly, with this administration, uncertainty is the key word here.
Right. Well, when we look at what people are doing with their money, we're looking at the present decisions they've made with their money, how they're investing it, how much they're saving, what kind of returns they're receiving, what kind of risk they're taking. A lot of people are blindly saving and investing. They're not looking into the future to see what they really need to save today to make the future work out financially. And when we start looking at, say, investment portfolios and people are taking too much risk, not getting enough yield for that risk, we show them things that are in their blind spot that they can take advantage of with strategic investment strategies, whether it's proactive money management or product types. There are things today, because the investment world is so diverse with so many choices and opportunities that a lot of people aren't that familiar with, that we can educate and then validate and show them how do you tweak things so you can get better returns and take less risk. And if we put a tax strategy in place and they pay less in taxes, we're looking for inefficiencies in what impacts their money with what they're currently doing. And if we find these inefficiencies, we can help people overcome some of these increases that they're going to experience with what's going on, because they're losing money in different ways that they don't even see it. And if we can uncover that and prevent that from happening, and then turn the tides on their money working more efficiently and take less risk, then they can really have a fighting chance against what's going to happen with inflationary pressure on the things that they're going to spend their money on, right? Mm-hmm. And so, it's what you don't see that can hurt you. And this is what we want to bring to light. We want to show people what's going on in their blind spot that's affecting their money in a negative way, and give them better control over how to manage that, get better results going forward, and then have the opportunity to pivot when things change that they weren't expecting, but their plan has been stress tested to absorb that. And when we say stress test, we're going to look at, can you make things work with a higher inflation rate or higher tax cost or higher spending goals? Because things might change in the future that you didn't predict, but we want to see where is your stress level of that plan where it starts to fall apart. And so we want to make sure that people can pivot with change, because we're always going to have change that impacts your money, good or bad. It's going to take a plan that puts you in better control over how to control that and have better results in the long term.
Even with volatility in the stock market, there are those who remain bullish. One is market strategist Ken Paul Carey. He cautioned Fox Business that there's one thing that could throw a wrench in the picture.
I think the problem this year is going to be inflation. I think the Fed was too aggressive last year when they cut rates. I think they reignited kind of the inflation monster. And so I think the Fed's going to have to stand pat. Now, to that point, it doesn't mean that the market can function. We can have 4.5% or even 5% 10-year if the economy remains strong and vibrant and robust. The problem's going to be is if we start to see the labor market weaken or the economy weaken, and then we see inflation move higher, that would then be the issue.
Big statement there. He says if the economy remains strong here. So is that too many ifs for an investor who's nearing retirement and maybe looking to protect what they actually have?
Well, I'll tell you, when you're getting close to retirement, it's extremely important to protect your account values, especially if you have a sizable sum of your nest egg in the market, because if you see a big downturn in your account and portfolio values, that might change your decision, or you might be forced into changing your decision when you retire or how much you can live on in retirement. I remember back in 2007, 08, 09, if you remember the big drop we had in the markets back then. And a lot of people lost half their money. And I dealt with some folks that were just newly retired, had been in the market, and what happened was they saw a big drop in their portfolio that they were using to draw an income from. And that's a quick way to derail your retirement if you don't really protect yourself from that happening. And that's why it's important to have a strategic income plan that's designed that can create the yield and the income without selling off shares to support you. And it's a whole different ball game when you're in your accumulation years and you're saving money and you have that paycheck coming in every month and you can pay your bill. And you don't really worry about the fluctuation in the market too much because you feel that, well, I have years before I retire. It'll come back someday. That attitude doesn't work when you get close to retirement. And so back in that day, we had a lot of calls and we brought in a lot of people that experienced that, and they were petrified because they saw how fast that things changed. And we can avoid that from happening and protect people from those impacts when, the markets go off the rails. And today, I look back to 2022. Same situation when the markets were down. The S&P was down 18%. NASDAQ was down over 33%, and the Dow was down that same year, and bond funds. And that caught people off guard because they thought their bond funds were there to kind of stabilize the portfolio, but they lost money at the same time. And so what we try to do is evaluate the timing of when they're going to retire, what kind of income they're going to need to create, adjusted for inflation. And we use different inflation factors just to stress test it like we were talking about, and taxes. And what we're finding most often are people are still in their growth type investment portfolio, and they were going to use that same mix when they retire. And it's okay when the markets are going up and a lot of people are selling shares to create that cash flow. Well, think about that. If you're selling off your shares, and a lot of people are in mutual funds, so they need to sell their shares because their income yields aren't high enough to create the cash flow. And when the markets go down, you have to sell off more shares. Now it's tough to recover from that, and that could prematurely deplete your nest egg in a very short period of time. And that's what's referred to as sequence of returns risk, which we show people how that works, how they're vulnerable to it if they don't take measures to plan for it. And so an income plan is probably the most important component in your planning, and people really need to learn that this is something you start to structure and put into place of maybe a year or two before you retire. And because we're also going to look at how are there ways available to make you more tax efficient and where your money is going to be coming from to supplement your income, because a lot of people are finding out, and it's too far in the game when they usually find out, is they put all their money in pre-tax retirement accounts, not really looking into the future to see what the requirement of distributions might look like. And for some folks who've done a great job in saving for retirement, they're finding out that they're needing to disperse more when their requirement of distributions come in than what they need to live and spend on. So that just creates a growing tax problem on the money and your other sources that are coming in. But market volatility, you can take control of market volatility to some degree with strategic planning strategies and product types. But what is really important is you want to align your investment portfolio with your tolerance for risk, but the benefits and financial objectives that you are going to need going forward, whether it's short-term and long-term. And this is something that we spend a lot of time on with each client, and we refine it. And then once the structure's in place, and we keep looking at it from year to year to make sure we keep people on track, because like we're talking about, there's always change. The markets are always going to be unpredictable, and inflation and taxes and spending levels and healthcare out of pocket. So it's something that I think if you don't put a plan in place, well, you're going to have a setback someday, and it's going to be a setback that we can't fix because it's too late in the game.
Right, and I think that's the whole idea is not to be too late to the game here. And you talk about, not forgetting the burn of 2008 or, another possible market crash that you were a part of, because it's really easy to live in that moment and think the world's over, and then all of a sudden you get back on track, the blinders go back on, you forget how terrible that was. And also, if you're close to retirement, I'm talking, 5 years or less, I mean, being involved in some sort of potential market crash, huge market volatility, depending on your risk tolerance, or if you even know your risk tolerance, could derail, if not just put off your retirement all in general. So this is where I think you would agree. It's all about having a plan in place, a protection in place, understanding your risk tolerance. I'm not saying don't put any risk in the market. It's not what I'm saying at all. I'm saying understand how much you're risking, so when and if that other shoe drops, what's potential out there.
Yeah, you don't want to be in a position of being reactive with your money, because usually when you're in that position, you're reacting to an event that has hit your pain threshold on your money. And that's a bad event. So now you're looking for alternative options to protect what's there, what's left. You want to be proactive. And proactive means you start taking control over your money today, better understand what you're doing with it and how that looks into the future, and then look at the weak points, the weak links, the weak things that your money isn't creating and doing for you by putting together a plan that might encompass a number of different financial strategies and tax strategies. So, and you always want to know, what do you need to save today and what rate of return you need to earn today between now and when you retire, but also when you stop saving in retirement, what return are you going to need to sustain your income plan? So if you want to really take a look at all the what-if scenarios or the ifs that could hurt your money, let's take a look at your current plan forward and then that allows us to be in a better position to really give you some good advice and maybe put together a personalized plan.
When you take all these different topics we've kind of, touched on today, between taxes and tariffs and market volatility and just kind of the uncertainty that we're in right now with high inflation, the tariffs going to, definitely bump that up a little bit. We're seeing the market volatility because of all these different decisions being made. It's that snowball effect like I talked about. So a lot of folks are just wondering, all right, listen, I got to find this money tree. I got to find this guaranteed income thing I've been hearing people talk about. And briefly, David, talk to me about those guaranteed income options that are available for folks out there that could potentially be a huge game changer for their retirement.
Yeah, I mean, if somebody's looking to have more predictability and lifetime income on top of their Social Security, because a lot of people today aren't retiring with pensions, so the Social Security is just not enough for a lot of people to live the lifestyle they want in retirement. So when we're looking at income guarantee planning as part of the overall plan, this allows people the opportunity to increase their floor of lifetime income for themselves, husband and wife, or a single person, and now give them the ability to know that worst case scenario, they can rely on a certain level of income that they can never outlive. And that gives people added peace of mind looking into the future, because quite frankly, the biggest fear that most people have is running out of money, right? And so this is one way that your plan could be designed to give you a level of opportunity to know that the worst case scenario is going to give you a certain level of income. And some of these income guarantee plans give you some inflation adjustment increases, which is nice. That's pretty important long range. And some of the benefits of these guaranteed income plans could help supplement your out-of-pocket health care needs in addition to an inflation increase. So a lot of people, can customize their income plan by looking at some of these tools and these strategies. You don't have to always rely on your savings or your investments that might be fluctuating and be exposed to market risk or maybe too low of a yield to keep pace with inflation. So income planning is the most important tool going forward in your retirement. And it's got to be aligned with your own personal needs and objectives, which I haven't seen ever. I mean, I've been doing this for decades, and I've yet to see anybody with a strategic income plan. They're just working off of their savings nest egg, hoping for the best, and you don't really want to move forward with a plan of hope. So if these are things you're thinking about and you want to have a better idea as to how retirement might look in the future, give us a call. Let us do the complimentary forecast analysis and give you some insight on what's working and what's not, and how you can better optimize your opportunities going forward in retirement.
For more details or to sit down with David for your complimentary financial GPS, visit masteringyourwealthradio.com.
Investment advisory services offered through Brookstone Wealth Advisors, LLC, BWA, a registered investment advisor and an affiliate of Brookstone Capital Management, LLC. BWA and First Financial Planners are independent of each other. Insurance products and services are not offered through BWA, but are offered and sold through individually licensed and appointed agents.
Information provided is not intended as tax or legal advice and should not be relied on as such. You are encouraged to seek tax or legal advice from an independent professional.
Any comments regarding safe and secure products and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Fixed insurance and annuity product guarantees are subject to the claims paying ability of the issuing company and are not offered by Brookstone.
Registered investment advisors and investment advisor representatives act as fiduciaries for all of our investment management clients. We have an obligation to act in the best interests of our clients and to make full disclosure of any conflicts of interest. Please refer to our firm brochure, the ADV 2A Item 4, for additional information.